I mean, the NFT thing is so big. You know, everyone gets caught up in how much money there is right now. It's so much bigger than that because it's kind of like 1996, 97, 98 for internet. You know, when the internet came, there was so much money, go public. But then in 2000, all the stocks went to zero. But in all that zero, eBay and Amazon were there, and they were meant to be eBay and Amazon. And that's what's gonna happen with NFT.
Everyone laughed when the last pixelated ape sold for pocket change. The internet had its fun, roasting NFTs as overpriced and calling the whole trend dead. But the numbers tell a different story. Ethereum NFT trading volume recently climbed back over $1 billion in a single month, the strongest showing since the 2022 peak. At the same time, venture capital firms are still pouring billions into NFT marketplaces, gaming platforms, and infrastructure projects. So before we write NFTs off as a passing fad, we have to ask, could we be on the edge of a 2026 comeback wave? One that might make the 2021 mania look small? Remember when a pixelated rock somehow sold for more than a Beverly Hills condo? Back in the mania of 2021, NFTs were everywhere. Trading volume exploded to $26 billion in a single quarter. Celebrities were launching collections, and entire Discord servers lived and died by floor prices. Then came the hangover. By early 2023, trading volume had dropped over 90%. Average sale prices collapsed from nearly $3,900 to around $150, and daily buyers fell under $40,000 for the first time in years. Twitter dunked on bag holders, Saturday Night Live turned the crash into comedy, and group chats turned into therapy sessions full of ski slope charts. It wasn't just a correction. Half the NFT marketplaces either shut down completely or pivoted to totally different businesses. That's why today's rebound is so hard to take seriously at first glance. After living through the bubble, most people have sworn off NFTs forever. But the numbers are creeping back up, venture money is returning, and developers are quietly building new use cases. The comeback might not look like the Wild West of 2021, and that's exactly why it could be even bigger this time. OpenSea's weekly trading volume is up over 300% since January, and Blur's reward programs are once again pushing daily trades past $200 million. Even Bitcoin now hosts Bitcoin ordinals, a market worth roughly $250 million. On Solana, NFTs have exploded, over 1.2 million daily transactions, now surpassing the number of transactions in Solana's DeFi apps. Here's the part most people miss. The number of wallets holding at least one NFT has grown every single quarter since the crash, from about 7 million to more than 14 million today. In other words, while prices tanked, the user base doubled. It's the same pattern we saw after the dot-com bust. Amazon's stock price crashed, but adoption kept growing, and eventually the price caught up in a big way. If history rhymes, we could see the same thing here. Prices often follow users, not headlines. 1. Real-world assets on-chain. In March, BlackRock tokenized a $100 million money market fund, and Franklin Templeton already manages a $430 million on-chain treasury. Real estate NFTs let you buy a small share of a hotel room in Dubai and actually collect a slice of its nightly revenue. By 2026, experts project the market for tokenized real-world assets could reach $16 trillion. That's 400 times larger than today's entire NFT market. 2. Gaming finally has rails. NFT gaming is no longer just an idea, it's here. Illuvium's open-world beta already has 350,000 players. Ubisoft's Champions Tactics made $10 million in cosmetic NFT sales in a single night. The Epic Games Store now lists 20 NFT-based titles, and Mythical Chain has passed 5 million wallets. Deloitte predicts blockchain gaming will hit $150 billion by 2026, with in-game NFTs accounting for 40% of that spend. If you thought Bored Apes were speculative, just wait until teenagers start buying tradable skins the same way they used to buy V-Bucks in Fortnite. But now, with real resale value. 3. AI-generated, AI authenticated AI is creating and verifying NFTs at scale. Artists are using tools like Midjourney to generate artwork, mint it as NFTs, and prove its authenticity on-chain. Collectors get unique AI pieces they know are one of a kind, and creators keep up to 98% of the revenue thanks to smart contracts. Platforms like NiftyML have seen monthly NFT mints triple since GPT-4o launched. By 2026, generative AI content could account for 30% of all new NFTs, turning today's free social media posts into monetizable, verifiable digital assets. 4. Regulatory guardrails. Clear rules are finally arriving, and that's a good thing. Europe's MECA framework explicitly classifies royalty-granting NFTs as different from securities, removing a major legal risk. Japan's government is issuing tax vouchers as NFTs. In the US, the SEC recently closed 2 big cases, signaling that utility NFTs are mostly outside securities law as long as they don't promise profit sharing. This clarity is attracting institutional players. Coinbase Custody already holds $130 million in NFTs for pensions and endowments. Legal clarity plus secure storage is the final green light for more conservative capital to enter. 5. Bitcoin ordinals and the halving supply squeeze Bitcoin isn't just sound money anymore. It's becoming an NFT layer. The 2024 halving cut miner rewards in half, and ordinals are filling up block space. Since the very first inscription, miners have earned $450 million in fees, money that used to flow only to Ethereum or Solana. By 2026, we'll be 2 halvings deep, meaning Bitcoin's supply will be even tighter, while ordinal culture keeps growing. That combination could make Bitcoin the world's most valuable NFT network, which sounded ridiculous once, but so did colored coins a decade ago. Grandview Research valued the NFT market at $26 billion in 2023 and projects an annual growth rate of 33.7% through 2031. At that pace, the market could reach roughly $120 billion by 2026. Even the infrastructure side is growing. Dapradar's conservative estimates put base layer NFT infrastructure spending at about $13 billion. And with unique wallet counts growing by around 13% every year, network theory suggests the overall value could rise exponentially as more users connect. That math points to a potential market value in the $250 billion range. Even if only 40% of that scenario plays out, it still implies a 5 times expansion from today's levels. In other words, whether you look at conservative research or network-driven projections, both suggest that the NFT market could easily surpass its 2021 peak, and potentially do so by 2026. Here's the uncomfortable truth. Just because the overall market grows doesn't mean every coin or NFT project will go up in price. NFT Worlds trades for less than a penny, and App NFT is priced so low it's practically zero. Most NFT collections will still fade away over time. Why? Because supply is endless. Anyone can launch a collection, but human attention is limited. It's the same story as the .com era. Sure, Business.com sold for $7.5 million, but thousands of novelty domain names became worthless. The big trend will lift a handful of standout projects and platforms, not every random token or profile picture project. If you want exposure to the space, you're often better off focusing on marketplaces, infrastructure tools, and layer 1 blockchains, rather than gambling on every new NFT drop that promises to be the next big thing. If you find this information valuable, make sure to subscribe so you don't miss out on future videos. Here's the part no one likes to talk about: the risks that could break this rally. If the Federal Reserve keeps interest rates high, money stays expensive and riskier assets get hammered. When that happens, NFTs are usually the first to get sold off. Even if the macro picture holds, the tech still has to keep up. Ethereum's latest upgrade made transactions cheaper, but if future upgrades stall and gas fees spike again, casual users will vanish as fast as they arrived. And then there's regulation. One harsh law requiring identity checks for self-custody wallets could freeze the entire market overnight. Add to that the security problem, one massive breach could crush confidence completely. Finally, there's the court of public opinion. Environmental criticism of blockchain still polls strong, especially with younger voters. That could lead to real political action, and the fallout wouldn't just hit Ethereum, but Bitcoin ordinals too. The point is clear. This market doesn't just rise and fall on price charts. It lives and dies by macroeconomics, tech upgrades, politics, security, and public perception. And all of them can change overnight. Look at where the smartest money is moving. Andreessen Horowitz, better known as a 16Z, just raised more than $7 billion across 2 new crypto funds, with over $1 billion set aside specifically for NFT gaming projects. Paradigm, another heavyweight investor, is sitting on nearly $1 billion in dry powder and is actively looking for bets on on-chain royalty systems. Traditional finance is circling too. VanEck now offers an on-chain treasury product that manages roughly $250 million and settles instantly. Essentially, a money market fund that uses NFT tokens. And the whales are moving. Wallets linked to Jump Crypto have scooped up more than 4,000 ETH worth of CryptoPunks since March. When some of the sharpest quant firms in the world start quietly buying vintage punks at a 70 ETH floor, you don't have to trust the hype. You can just follow where the serious bids are going. Here's a simple framework if you want exposure without blowing up your portfolio. Step 1. Keep NFTs a small slice of your overall strategy. No more than about 5% of your total investments. Step 2. Diversify inside that slice. Put roughly 40% into marketplace tokens like Blur or Magic Eden governance, about 30% into gaming NFTs from games with more than 100,000 active players, 20% into tokenized real estate platforms, and the last 10% into Bitcoin ordinals or rare Satoshis. Step 3. Don't rush in all at once. Spread your buys over the next 12 months instead of piling in over a single weekend. Step 4. Use a hardware wallet for storage. Nearly half of NFT hacks last year came from people signing malicious transactions with hot wallets. Step 5. Plan your exits. For example, every time your position doubles, take about a quarter of the profits off the table. Keep doing that as prices rise. In this market, discipline and risk management will always beat blind diamond hands. So, will NFTs make a comeback in 2026? The numbers suggest the rebound isn't coming. It's already underway. Wallets have doubled, trading volume has tripled, institutions are raising billions, and regulations are finally taking shape. Sure, most individual tokens will still behave like penny stocks on caffeine, but the overall market is growing faster than it did in 2021. If you hate the hype culture, that's fine. Focus on the infrastructure, the marketplaces, the custody solutions, the tokenized real-world assets. Think of it like selling picks and shovels during a gold rush. Whatever you do, don't mistake a quiet rebuild for extinction. That's exactly what the permanent skeptics did with Amazon back in 2002. History doesn't repeat, but it does rhyme. And this rhyme could be worth $200 billion by the next Bitcoin halving.